Okay, hi everyone. We're going to get started here in just a minute. I just need to pull up the slides. Okay, everyone see the first slide okay? Now let's go ahead and get started. So welcome to What is our evidence-based investment philosophy and why does it matter webinar. My name is Mark Lund. I'm excited to share this information with you today. So today I'm going to be using some of the examples from my book, The Effective Investor, and then at the end I'm going to tell you how you can get a copy for free. Now, just a couple housekeeping items. Over to your right, you're going to see a place where you can submit any questions you may have as we go through this webinar. And I'll be reviewing all the questions at the end, so feel free to ask any questions throughout the presentation. But to keep things moving along, I'm going to hold off to doing any Q&A until the end of the presentation. So any questions you have throughout the event, don't worry, I'm going to answer them. And if I don't get to them in the presentation, I will follow up with you. So today's presentation is to help you understand our evidence-based investment philosophy and why it matters. I mean, it really does matter, especially when it comes to building long-term wealth for you and your family. Now, evidence is extremely important. It's important in everything we do because it can prove things to be true, but it can also prove things to be untrue. And what it certainly does is it helps you make an educated decision about how to invest your money, which is why we're all here today. So what's the definition of evidence? It's the available body of facts or information indicating whether a belief or proposition is true or valid. What we know is that there's a mountain of evidence out there that exists that can clear the path for investing success. There's also a lot of myths out there, so we also want to debunk what those myths are. Okay, so there's three portions of this presentation. The first is what I want to talk about is evidence that has positively impacted results in nearly every aspect of our lives. The second is absent evidence. So investors can be lured into making harmful investing decisions. And the third will reveal evidence that is critical for investing success. So the first part of this, evidence has positively impacted results in nearly every aspect of our lives. So evidence supports theory. People have ideas about how the world works, and then they look for evidence to prove whether those things are true or false. So first let's take a look at science, or evidence in science. In science it looks like this. Now, anybody familiar with this image of the Earth? This is what we call the flat Earth. You can imagine before evidence started to mount up and people started asking questions and finding proof about this theory, the only evidence anybody had about whether the Earth was round or flat was looking out at the horizon. Now we know today with images like this, you can see pictures from space, the curvature of the Earth not being flat, right? So you can see that it's a sphere. And now you may be sitting there thinking, okay, Mark, I get it. But in today's day and age with technology and Photoshop, you could have just created that, right? But the reality is this, an eclipse casts a shadow of the Earth on the moon from the sun behind it. And if you look at what an eclipse looks like, is this shadow curved or straight? It's curved, right? So a flat Earth can't have a curved shadow. So the evidence is very clear that the Earth is round. So how about medicine? What does that look like? Now here's a picture of some kids riding a bike. Now, how many of you rode bikes when you were kids? And did you wear a helmet when you rode your bike? So the question is why not? So the answer might be they weren't invented, they weren't there, they didn't know about them yet, all sorts of reasons. Now I'll take it a step further. If I had worn a helmet riding a bike when I was a kid, I would have been made fun of or ridiculed. But evidence and statistics start to prove things that you should be doing in your life to keep you safe or help you help you make better choices, right? So the first evidence that has shown up about helmets or riding bikes is that they've found that almost 3/4 of fatal crashes involved a head injury. And they also found that nearly all bicyclists who died 97% were not wearing a helmet. So the evidence is mounting massively, so much that you cannot, my guess is that you cannot imagine sending your child or your grandchild out on a bicycle without wearing a helmet these days. In fact, this is my boy Trevor. He's a lot bigger now. This is when he was little. I was up teaching him how to snowboard, and he's much better than me now, and he always likes to remind me of that. But he wanted to learn to snowboard, and you can see him wearing his helmet here. Now in this picture, when I learned to snowboard, I never wore a helmet. Yet one of the first things I bought Trevor before we went up was a helmet. And when he asked, why do I have to wear a helmet? Do you think I said, well, 3/4 of fatal crashes involved a head injury. I don't know. I don't have to prove it to him. I know that him wearing a helmet is the best thing for him to do. So I tell him, you know, I say something like, you have to wear a helmet because I know what's best for you. I'm your dad. I love you. I want you to be safe, right? So here's the question. Do you think he made it through the day without falling? Of course not. So what about law, evidence in law? What does that look like? Now I have a little clip here that I think is going to help us out, and I think you're going to like it. Okay, here we go.
On cold case files, they solve old murders. And it's really interesting because what I learned from it is that it was really easy to get away with murder before they knew about DNA. It was ridiculously easy. Like, what was even going on back then? What was a murder investigation like in 1935? One cop would just walk in and be like, "Detective, we found a pool of the killer's blood in that hallway." And he would just be like, gross. Mop it up. Now then, back to my hunch.
So the reality is that in today's day and age, knowing what we can prove with DNA evidence, you would never do that at a crime scene, right? But you can imagine before DNA evidence existed, that's probably how it went. Gross, mop it up. I'm going to follow my hunch on this one. So the absence of evidence, investors can be lured into making harmful investing decisions. Most investors do not make investment decisions based on evidence. They just don't. They make it based on a hunch or a feeling about what they think is going to happen. And it shows up in different ways. Now the first that we're going to talk about is market timing. So what is market timing? And I'm going to define it for you. Market timing is the act of moving in and out of the market or switching between asset classes based on using predictive methods. As if you know exactly what's going to happen in the future, whether it's going to go up or whether it's going to go down, and you can get out or in based upon that feeling of the future. Now there's a lot of people that manage money like this. In the industry, we refer to this as active management. So here's some examples. This is a Time magazine cover in March 2009, and I didn't recreate this with Photoshop. This is the actual Time magazine cover. The headline says, "Hold on for dear life, the economy and you, a special report." And you got a person holding onto a rope that's frayed and about to snap. Now, what do you think the message is they want you to take away from this image? Do you think you can take away that the market's going to go up or down? Down, right? The significance of this magazine cover is that it was printed on March 9th, 2009. Now that date is historic as far as the market's concerned because that was the absolute bottom of the crash of 2008. So if you would have seen your portfolio going down, and we're in a checkout line in a grocery store, and saw this cover of Time magazine, you wouldn't be feeling very good. So what might you do? You may be really tempted to get out of the market, right? And if you would have got out, you would have locked in your losses and would have missed out on all those gains, 100,000 growing to 485,000 during that time period. Okay, let's take it a step further. Some very smart people behind this evidence-based investing strategy. William Sharpe is a Nobel laureate. Now, he did a study called The Likely Gains from Market Timing. Most people think that if you're going to time the market, that you only need to be right twice, once to get out and once to get in. But the reality is this: if you're looking at just those 2 points in time, what you're comparing to is a return of 0. And that's not how the market works. Markets have long-term, they have positive returns associated with them. So you have to compare it to what? You have to compare it to owning a market portfolio. So what if I just own the market versus what a market timer would do getting in and out? And the statistics show that if you compare that, which is the fair comparison, a market timer has to be right 74% of the time. Now you can imagine the risk of trying to be right 74% of the time, not just 50%. So here's an example I used in my book. Here you'll see that over this 20-year period, there was a total of 5,040 total days you could have been invested. If you had invested 10,000 on day 1 and stayed fully invested for the entire time, your money would have grown to almost 50,000. On the other hand, if you had jumped out of the market and missed just 10 of the best days out of the 5,040 days, your money would be worth less than 25,000. So missing just 10 of the best days would have cut your returns in half. No one knows when the best days are going to be. If you're already out of the market, it's too late to get back in. And that is just
gross. Mop it up. Now then, back to my hunch.
So you don't want to be making your investment decisions based on a hunch, because that definitely is gross. And the evidence is clear. You should not attempt to time the market. Okay, so let's move on to the next one. Security selection. What is security selection? This is also referred to as stock picking. Security selection or stock picking is the act of picking winning or losing stocks based on using predictive methods, or in other words, a hunch. Like somehow someone knows, or you know, what stocks are going to be great and what stocks are going to be bad in advance, and you buy the ones that are going to be good and you sell the ones that are going to be bad. So does that work? Let's take a look at the evidence and see how the best stocks lists did in 2016. The best stocks lists are published every single year. These are predictions of these so-called experts published in these magazines. This was in 2016, just for an example. MSN Money, they had the 10 best stocks to buy in 2016. And if you would have listened to them, you would have made 2.3% return that year. So is that good or bad? If that was the 10 best stocks, certainly no one could do better, right? Kiplinger's stock picks in 2016 actually did better. They did 3.7%. Can you do better than that? Money Magazine, they had the best investing moves. How can they both be the best? So best investing moves of 2016, they made 4.9%. Taking it out a step further, Barron's had their 10 favorite stocks for 2016. They made 5.3%. So is that good or bad? And what should we compare it to? The 2.3%? How about we compare it to investing in a market portfolio? And if you would have done that, you would have made 12.8%. That's using none of their stock picking strategies. So is that better or worse than listening to the advice of the magazines? Okay, anyone know what this game is? So this is called Bean Boozled. A lot of people love this game. A lot of people don't. So here's how the game works. So you spin this little wheel, and the color it lands on, you have to pick a jelly bean of the same color. The problem is, for every color there's a good flavor and a bad flavor. So for example, you might get lime or lawn clippings, or peach or barf. Yeah, it's gross. Or say strawberry, banana, or dead fish. The worst one's probably dog food. So it's bad. You're probably thinking, okay, we're talking about investing. Now we're talking about jelly beans. So don't worry, I'm going to tie it all together for you. Just bear with me. On the left, we have the S&P 500. This is the 500 largest companies in the US. On the right, we have a jar of jelly beans. Let's just pretend that there's 500 jelly beans in the jar. In any given year, the approximate number of stocks in the S&P 500 that underperform the S&P 500 index is approximately 300. So in other words, 300 out of the 500 are really bad every year. So more than half in any given year. So let's pretend that this jelly beans jar has 300 bad jelly beans in it. And we'll pretend that these represent stocks. So I have a question. If we were meeting in person and I brought my jar of jelly beans, 300 tastes really bad and the rest tastes good, would you be willing to pick a jelly bean and eat it? What if I told you that the bad jelly beans will make you really, really sick? Would you still be willing to pick a jelly bean and eat it? So here's the thing. The statistics show that there's going to be around 300 bad stocks in any given year out of the 500. And you may be thinking, well, if I were to pick stocks out of the S&P 500, I would pick big, well-known companies. Then I would tell you, or I would remind you, that when you get a bad one, they're really, really bad. And then I would give you some examples like these. Now, this is the largest bankruptcies in history. Do you remember this? Enron. Does anyone remember this? Yeah, 65 billion lost. CIT, 71 billion lost. GM, 82 billion lost. You remember these. WorldCom, Washington Mutual, Lehman Brothers. Yeah, when you get a bad one, they're really bad. Now look at this, 600 billion. Absolutely gone. And the other thing I want you to pay attention to on this is I listed the sector that it's in. So no sector is immune either. You got automotive and energy trade and banking holding companies and telecommunications. When you get a bad one, it's really bad, just like the jelly beans. And I think we can all agree that that is...
gross. Mop it up. Now then, back to my hunch.
So again, you don't want to make a hunch. You don't want to pick stocks based on a feeling. The evidence shows that you should not try to pick stocks. There is a better way. Jack Bogle, he founded Vanguard Group, and he very simply said, don't look for the needle in the haystack, just buy the haystack. That way you get all the needles, and together they do really well over long periods of time. So how about chasing performance? This is also referred to as track record investing. The definition of track record investing is using performance history, we can identify the best investments for the future and beat the market. So in other words, people will try and pick investments based on past performance. The idea is that if a manager had good performance in the past, they must know how to pick stocks and be able to beat the market in the future. Instead of making this assumption, let's take a look at the evidence. First of all, what I want to show you is this statement. Past performance is no guarantee of future results. Now, have you ever heard that before? Why have you heard that before? Because it's required by law to be published in every single piece of performance literature you've ever received. Now, do you know why? Because it's true. Just because some manager got lucky in the past does not mean that they're going to do it again in the future. And if you look at the numbers, the evidence, you will see it is totally true. So Bill Miller, Legg Mason fund manager, he's a famous guy in the investment world. In 2006, Smart Money magazine touted him one of the world's greatest investors. And right after they published that in 2008, he bought AIG, Wachovia, Bear Stearns, and Freddie Mac. The later three were almost wiped out, and he rolled them all the way down. So past performance is no guarantee on future results. Let's take it a step further. Now here's some more evidence. So this chart shows you year by year who the top 100 managers are or were. So the next column shows you how many of the top 100 remain in the top 100 the next year. So in 2004, we have the top 100. In 2005, only 15 remained. Of the top 100 in 2005, only 16 remained. Of the top 100 in 2007 and 2008, only 0 remained. So they just don't repeat. It doesn't happen. This is just 1 year later. So the longer we go, after they were in the top 100, they don't exist. In other words, don't play the game of track record investing or chasing returns. It's a loser's game. Past performance is no guarantee of future results. Yet this is how so many advisors sell investments and how so many consumers buy investments based on the past performance. The evidence just doesn't support it. This is a confession of a former mutual fund reporter. One anonymous Fortune writer wrote this in 1999, and here's what they said. By day, we write 6 funds to buy now. By night, however, we invest in sensible index funds. Now, these are the authors of the magazines. They're buying broad market-based indices because that's the smart thing to do, and that's what the evidence says you should do. But they write headlines that say counter to that because that's what sells magazines. Now, unfortunately, rational pro-index fund stories don't sell magazines or cause hits on websites or boost Nielsen ratings. So you can rest assured you're going to keep seeing these types of exciting enticements on magazine covers with titles like 6 funds to buy now. You're going to keep seeing these headlines as long as there's personal financial media. Now, do you all agree with me that that is absolutely
gross? Mop it up. Now then, back to my hunch.
So the evidence states that you should not try to pick investments based on past performance. Or in other words, you should not chase returns. So if those things don't work, the question is what does work? What is the evidence that you need that is critical for effective investing? Well, the first thing you need to know is that evidence-based investing eliminates those 3 things we just talked about. It eliminates the market timing, stock picking, and it eliminates track record investing. Well, what does it do? What does it incorporate? So this is the evidence-based silver bullet, okay? So it comprises 4 main components. Now you'll want to write this down. It incorporates Nobel Prize winning academics about how markets work. The first component is efficient market hypothesis. Now this idea was first developed by Eugene Fama in 1965. Eugene Fama is a distinguished service professor of finance at the University of Chicago, and he's credited with founding the efficient market hypothesis. In his 1965 PhD dissertation, Fama said this: in an efficient market at any point in time, the actual price of a security will be a good estimate of its intrinsic value. Now, the second component was developed by Eugene Fama and Kenneth French, now known as the 3-factor model. So we'll talk about that a little bit later. Now, the third component is modern portfolio theory, which is the idea that you want to diversify globally. And the fourth component is behavior. We must understand behavior. You want to avoid emotions when investing. So if you can't beat markets, what should you do? That's right. If you can't beat them, join them, because they really are great wealth creation tools and they will help you long term. And if you look at what a market return is, just to put it in perspective, from 1994 to 2021, the S&P 500 was about 10% return. So if you start to go down on the safety scale, you go into some 5-year U.S. government treasury bonds, fixed income, and you have a lower expected return but less risk. So 4.5%, 1-month T-bills, very safe at 2%, and inflation at 2.3%. The goal of investing always should be to outpace inflation, because inflation will erode your wealth and erode your spending. So you want something higher than this in your return. Otherwise, it's just not worth it. So this chart's busy, so stick with me, I'll explain it. Most people think, and I hear this a lot, most people think that $1 million is absolutely unachievable in their lifetime. Most people think that, but the reality is it's not. If you do two things. First, you have to save appropriately, and second, you have to invest appropriately. In other words, you don't speculate and gamble. So this is how it works. This is really cool. So this chart shows you that the first 100,000, it's the hardest. It's always the hardest to get is the first 100,000. You've probably heard compound interest is the eighth wonder of the world, and it really is cool how this works. So in this example, if you just save 10,000 a year at 7%, the first 100,000 takes you about 7 years to get. Now, as I go out across the bottom of this chart, the next 100,000, does it take more time or less time to get to? And I didn't change anything. So it takes less time, right? I didn't change anything. I saved the same, got the same return, and I changed nothing, but it was less time. Now, how about the next up to 300,000? Is it less? So it's about 3.7 years. Look how short it is to go from 600,000 to 700,000, 1.8 years. The last 400,000 takes less time than the first 100,000, and nothing changed. You saved appropriately and you invested appropriately. That's it. That's how compound interest works. So how about the small factor? What's that look like? Very simply put, all large companies started small. Now this next slide I'm going to show you is what is referred to as the garage effect. It's the idea that there are always people out experimenting in garages with new ideas about a company they want to start. And there's a lot of people doing it all over the world. So here's some examples. So Harley Davidson started in this garage right here. And Apple started in that garage. And I'm not joking, these are the garages these companies started in. Mattel started in that garage, Google started in that garage, Disney started in that garage, and Amazon started in that garage. So there's a lot of people doing a lot of things in garages. So the idea is you want to own all of them as they become public because they all have a higher expected return. Small companies have higher expected returns and can be great diversifiers because if a small company becomes a large company, they provide wealth. They provide a return on that capital that you're deploying to them. So if you look at the evidence, the numbers from 2000, the bottom line is the S&P 500, a 100,000 investment grew to 494,000. A 100,000 investment in small stocks grew to 595,000. That's how it works. Now we don't know which ones are going to be the next Amazon, so you broadly diversify across them and they have a higher expected return. Okay, so how about the value factor? Now value companies, that means for some reason or another the companies are distressed. And they too become growth companies. So the distressed companies may become healthy someday. And as they do that, they provide a higher expected return. So I'll give you some examples here. So Apple almost bit it in the late 90s. Did you know that? Late 90s, they almost went under. In fact, Microsoft had to bail them out. It was almost gone, and then it became the largest company in the world. Now, who thought that was going to happen? How about this? CBS took a commercial break in the mid-90s. Nintendo hit the restart button in the early 2000s. Okay, anybody picking up on what I'm doing here? Restart button, bid it. Okay, it's not the funniest joke. Delta was grounded in the mid-2000s. Starbucks had trouble brewing in 2008. And Netflix lost Steam in 2011. Okay, the reality is that in some point in their history, these companies became distressed. Or in other words, they were value companies at one point. Now they're some of the largest, most well-known companies in the world. No one knew which ones were going to do that. So you own them all, and they all have a higher expected return. Now, if you look at the numbers in the same exact time period from 2000 to 2021, the S&P at the bottom, the small stocks are coming in the middle at 595,000, the small value stocks at 811,000. And that's just how it works. You don't want to just load up on these guys, you want to diversify. Now, Merton Miller, Nobel laureate, has a great saying. It's very simple. Diversification is your buddy. And what I mean by that, and how many people have heard this, don't put all your eggs in one basket. What exactly does that mean, though? So what it means is, what most people apply it to is you don't put all your money in one stock. That's how most people apply it. But you don't want to load up on just one stock. So we proved it with the evidence. We talked about that. And you don't want it, and you just don't want one bad jelly bean, right? But you can take it a step further. You don't want to put all your money into one sector. Now remember the slide where we're talking about different sectors? No sector is immune from the down market, from having a bad day. And you also don't want to put all your money in one country because some countries are up when other countries are down. That's just how it works. Diversification is awesome. And if you have a diversified portfolio, this would be an example of what that would look like. So this is a 60-40 mix. That just means you have 60% stocks and 40% fixed income. Then this is a globally diversified portfolio. Small stocks, value stocks, the ones we just talked about, international diversification. Have you ever seen a chart like this before? This is called the Markowitz Efficient Frontier, and Harry Markowitz won the Nobel Prize in 1990 for this. But this idea, he wrote a paper on this back in 1952. So you have to say, what took so long? The reason why it took so long is computers weren't strong enough to test his theory. It took that long for them to be able to develop to the point where they could prove that what he was actually saying was right. And the idea was this. It's really simple. You can maximize the return for a risk that you're willing to take for any portfolio mix that you're looking at. So a typical portfolio may look like the S&P 500 and some fixed income. And you may fall somewhere on that line depending on how much stock you have versus fixed income. So higher expected return with more stocks. When you use the evidence that we're talking about, you have the ability to potentially boost that line up by adding the small, by adding the value, by adding diversification. Those portfolios may fall on a frontier like this with a higher expected return. So for an example, if somebody was comfortable with the level of risk of the S&P 500, they would be better to move into more a growth or an aggressive portfolio, which gives them the same risk but a higher expected return. If somebody was not comfortable with the risk of the S&P 500, they would be better to move over to a more conservative or moderate portfolio, reduce the risk, but have a similar return as the S&P 500. So every single portfolio that we have on that frontier has a risk number. And you may or may not be familiar with what that is, but every single person watching this webinar, every single person you know has a risk number. And there's a way to calculate what that is. Now, there's this final thing called behavior. Benjamin Graham, the father of value investing, said, the investor's chief problem and even his worst enemy is likely to be himself. That is why you align with a trusted advisor to help you navigate what happens along the way, because it can and will be a roller coaster ride. Do markets just go up in a straight line? Absolutely not. They may look something like this, up and down. And you can imagine the emotional roller coaster that happens, especially when you're in the grocery store and you see those magazines, right? First, we start with the reluctance, the feeling of reluctance. Then as it starts to go up, you start to feel optimistic. And optimistic is good. People like to be optimistic. And then people start to get really excited. All-time high is coming. It's going to be great, right? And then what happens? What do most investors do when they feel this and they see this? What do? They start to get greedy. They want to buy. So they're buying high. So then let's just pretend that it starts to go down right after you buy. What's that emotion? It's denial. No way, can't be. And then it keeps going down. What's the next emotion? Fear. It's getting ugly. You're pretty much given up, and then you want to do what? You want to sell and you want to get out. You start to think, what if it never comes back? I better sell before I lose it all. You can't turn it off. It's an emotion. It's all you can think about. Then it starts to going back up, right? And then you're starting to feel depressed because you sold. So now you're back to reluctance, and you go through these emotions over and over again. This is why you need to work with someone who can help you manage those emotions, someone who can help you to buy when it's down, because most investors do the opposite. And what effect do you think that has on their wealth? I'm going to show you a chart here in just a bit, and it's ugly. It's really bad. This chart is really bad too. I don't think anyone can read it. I can't read it, but I know what the numbers say. This is a chart that lists the number of cognitive biases that are known today that affect human beings. And you know how many biases there are on this chart? 188. So they're saying 188 are affecting our decisions every day. And you know, when we start investing these things are playing part of our decision-making process. And it's been with us forever. It wasn't just yesterday. It started thousands of years ago. We're trying to fight for survival. We're worried about the tiger around the corner, and we're afraid. So all these things they're just hard-driven and hardwired into our brain, and they'll absolutely destroy a portfolio if you let it. So the evidence states that you should avoid emotional investing decisions. David Hume, he's a famous economist. Doug says a terrible dresser. A wise one proportions belief to the evidence. So how true is that? And I think that you all agree now that evidence can clear the path for investing success, and we encourage everyone to always invest with evidence. Okay, so some final thoughts here. First, if you submitted a question and it was not answered, I'll be in touch with you to make sure your question gets answered. Second, I have here a copy of my book, The Effective Investor. I'm going to give a free copy to everyone who schedules a complimentary consultation. So if you look up to your right-hand side of the screen, you can see a button you can click to get started. All you have to do to begin the process is simply click, Let's Begin. When you click this button, it's going to take you to a short form where you can schedule your free consultation. So once you schedule your appointment, we'll email you a first appointment questionnaire. The first appointment questionnaire gives us a brief overview of how you envision retirement, your current situation, and your investment experience. And when we meet, I'll clarify how you measure success and how we can help you with your investment and retirement plans. And don't worry, I'm not going to give you any awful jelly beans to eat. Okay, that's it for today. Thanks for being here, and I hope you have a great rest of your day.